Back to the storm at the corner of Wall and Broad that, of course, has been severe going into today. And a lot of this born of higher interest rates and concern that now they're beginning to stick and now they're beginning to register. These are session lows for the Dow, down about 426 points. I did have a chart before the Dow 30, if I can get that again, guys. 27 of the 30 stocks were down before. Save McDonald's, of course, which got an upgrade today, and Verizon and Walgreens, Home Depot, of course, benefiting from the hurricane. Procter & Gamble, Johnson & Johnson, and Coca-Cola, all others are down, and it looks by low 2-3 percentage point hits. Again, this hit on the Dow is bringing it back to levels. This seems severe where we were about a month ago. But again, the Dow is in and out of these 50-day moving averages that a lot of people pay close attention to. That is the same with the S&P 500, including this next guy, Gary B. Smith, who joins our panel here to discuss what's going on. On that 50-day moving average thing, Gary B., a lot of technicians, a lot of smart guys like yourself read a lot into that. There are these 50-day averages, 100-day moving averages. What do they mean? Why do you watch them?
Well, basically the 50-day average, Neil, as you well know, is just a trend, a longer-term trend. You know, the next stop, I guess, would be the 200-day moving average that technicians use. In this case, though, I don't think it has much relevance, to be honest with you. I'm looking more at the percentage pullback that we've had from the recent highs. I'm even looking back just at January of this year. We pulled back 10%. The S&P did from its highs until we started that great uptrend until the last week or so. Now we're down only 3% or so. Granted, some of the NASDAQ stocks have taken a bigger hit, but just in summary, I'd say we're getting closer to a buying opportunity than more selling.
All right. By the way, Dave, just so you're Gary, I was thinking David Asman because his name's up next, and all of these guys are going to be participating in this conversation. Gary, David Asman, Deirdre, Bolton, Susan Lee, and Charlie Gasparino. But before I get to David, open to ask the first question here. Is it your sense that in the past when you followed sell-offs, that individuals respond late? In other words, they start realizing the gravity of something and they panic, or is it just the opposite? What do you see?
No, I think you're definitely right. They're always the last to climb in as the market's going up, afraid of missing the move. Everyone else is making money. I need to get in, and normally the last to get out. Everyone says at the beginning, "Oh, I'm buy and hold. I'm going to be Warren Buffett." And they say, "Oh my God, my kid's college education is melting away." And they start to sell and panic. And that's when you see those big spikes down, the 500, 600, I guess now 1,000-point day it would be in relative terms. And everyone's out, and then the institutions come in and say, all right, we actually can stick in longer. We have more staying power. We have more resources. And that's where you start to see the bottom.
Oh, that's so true. That's absolutely true. There's also the computer trades. A lot of those kick in as well. So but it is the retail investor, the folks like us that make terrible mistakes at times like these, and you don't want to make those mistakes. Timing and buying individual stocks as opposed to a wide swath of stocks is usually the biggest mistakes that retail traders make is that they get caught up in you were talking about the psychology of the market. They get caught up in the psychology of the market that either good computer trades or the experts that have been around for 50 years don't get caught up in because they've been through it so many times.
Day-to-day moves, as Warren Buffett says, he doesn't time the market. He doesn't look at day-to-day. You have to look out further, right?
I think he lies about that. You know what I mean? Like he's like the standard stocks. I have actually. But do you think he's brilliant? Don't get me wrong. But I don't think he ignores developments like this.
He doesn't.
Right?
Definitely not. I've been following for years. The other thing is, I think that the difference with this market is that they are buying baskets of stocks, just so you know. This is less a market driven like you had in 2000 when the NASDAQ bubble blew up and people buying individual .coms.
Do we have a bubble to blow up?
You know, it depends. I mean, people have bought. Listen, this has not been a stock picker's market. That's why hedge funds are going out of business, right? So people are plowing money into S&P 500 funds and big indexes. They're buying baskets of stocks. So if you unwind those baskets in mass, you're going to have a
I understand that. But if you think about it, you could even argue with the huge technology run-up, right, Gary, that it is not obscenely rich, right? I mean, even in the case of Amazon, even in the case, you could make a case that it is not nutty.
Yeah, exactly. Look, I think I always go back to, at the end of the day, let's just say wildly we're down 1,000 points today. I don't think we will be, but let's just say we are. I just look at my own portfolio and I say, well, I'm still going to be paying my Amazon bill every month.
Not even 3%. What am I saying? But go ahead.
Yeah, exactly. I'm still going to be. I'm going to still be using Netflix. I'm going to still be going to the Safeway. We have the fundamentals. Wages, unemployment, housing prices are all pretty solid right now. You'd have to say,
one thing.
Is the economy in bad shape? I'd say it's in good shape right now.
Forgive me, Gary, but there's another Gary Kalbaum talks about this quite often, the unevenness of the rise of this market. There have been certain stocks that have benefited much more heavily than other stocks. And you can see that in the breakaway between the S&P and the Dow. The S&P, which represents about 500 stocks, as opposed to the Dow, which represents 30. I mean, the S&P hasn't done as well as the Dow has. So there's a certain unevenness to this market that concerns a lot of traders that are much smarter than me.
And nobody talks about the deficit that much anymore. You notice that? I hate to, again, the deficit represents higher interest rates if it grows much more. If it grows
I feel like we talk about deficit all the time.
Really?
We know.
Yeah, but I'll tell you, we're about the only ones who are.
We haven't mentioned it once in the last hour.
But I'm telling you, that is a ticking time. You're quite right about that.
I mean, nobody talks about the deficit. I mean, or rarely. I mean, you do, but I'm just.
But no, you're right about that.
It's a marginal part.
That is a ticking time bomb.
It's a marginal part of financial reporting right now because, and I'll tell you, that's a problem for us journalists because we are just not telling people that this thing is growing dramatically. And if you don't get good, really, talk to Mick Mulvaney. If you don't keep getting good economic growth, that thing is going to
Well, and the other part of it is interest rates. We worry about interest rates in terms of exactly. But the point is that the higher interest rates go, the more money it costs to service our debt. The more the debt grows,
isn't this the
more
year
money.
that
So
we're
this
going
could
to spend
really
more on interest for the debt than we do defense?
No, that's not quite.
It isn't quite.
That was thrown out. But that's not quite
when
true.
is it going to happen?
That's not quite true. It's not seven. We spend what is $780 billion on defense, and it's nowhere near the amount of money we're spending on that.
I think you're lying.
$21 trillion, if you want to do the math on that.
It really is an interesting thing about
the deficit is going to be $1 trillion. There's no question. Look, there's no way you can.
You sound like you're not even worried about burdening your children and future grandchildren.
You can't sugarcoat it. I'm worried.
Well, you are
primarily because it's spending. I'm not worried because of the fact. The problem with talking about the deficit, the reason why some people are hesitant to do so, is because the media, the mainstream media, is so quick to say, "Oh, it's the tax cuts. The tax cuts." No, it's spending that cause. Trump has a lot of other Republicans spends a lot of money.
David,
the revenue is actually increased. As Susan Lee just mentioned, revenue is increasing.
Of course it is, but does it increase enough for the tax? I mean, talk to any supply sider. They will tell you there is always a lag. I mean, supply siders that came up with the theory, Stockman, all those guys. There's always a lag.
Wait. Okay. Stockman was against supply side, not in favor of it. You're dead set. You're dead wrong.
At the time, he was for
He was dead set against it. You're wrong. That's why he was taken to the woodshed by Reagan.
That's right. No, he's taken to the woodshed by Reagan because he gave an interview to the
because he was against supply side economics, and he was wrong, and you're wrong if you're against it.
And here's what I will say. Everybody knows anything about supply side economics knows there's a lag.
It happens immediately. It happened immediately in 1983. Yes, it did. You're dead wrong.
All right, guys, I don't want to go back in time.